This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend Podcast. It was a holiday-shortened week for many, but that didn't make it any less busy, as we kicked off with a decisive victory for Donald Trump in the Iowa caucuses. We got more big bank earnings and a strong U.S. retail sales report. Yep, we were all out shopping in the month of December. And we also got daily headlines over what some have described as escalating tensions in the Middle East. This, a main topic that was on the minds of the folks at the annual meeting of the World Economic Forum in Davos.
On that, in Davos this past week, Robert Garrett, CEO of Hackensack Meridian Health, it's one of the largest healthcare systems in New Jersey, well, he stopped by to give us a checkup on global healthcare, including the role of AI.
It is everywhere. Also this week, a big deal in the chip space involving two companies that really aren't household names, and yet the deal, one of the largest in the last 12 months.
Plus, from Bitcoin to back to work, we've got the 5 ETFs to watch in 2024. And a little bit later on, we got Peak Ski co-founders Andy Wirth and Olympic and World Championship gold medalist Bodie Miller on disrupting the ski industry.
Yeah, that was a fun conversation. All right, all of that to come. We begin with the World Economic Forum's annual meeting in Davos, where some of the conversations there helped shape this week's narrative. This year's theme, rebuilding trust, and they were asking leaders who were there, will the coming year be a period of perma-crisis, or will 2024 be a time for resolution, resilience, and recovery?
There's some reason to look at the glass as half full. Maybe it's all the talk about a soft landing scenario and rate cuts. But on the other hand, as reported out in a Bloomberg Big Take this week, if the pessimists have their way, there are plenty of year-ahead risks to keep leaders awake at night.
That's for sure. That story, by the way, a collaboration between Bloomberg News and Bloomberg Economics. Bloomberg News global economics editor Ben Holland joined us with more.
Yeah, we started from the point that the pessimists have tended to get things right in recent years. And so obviously, after a few years in which we've had, starting with the pandemic, it was pretty clear to see all the things that could go wrong. And I think where we started was the two major conflicts that are still unfolding in 2024 with no evident end in sight, and most of all the Middle East, which is dominating our headlines every day. I think that was kind of the starting point for global risks this year.
Yeah, I think a lot of people, certainly if you would go back a year, did not see that coming. And at this point, we are more than 100 days into Israel's and the Israeli-Gaza war. But the threat is not just within that region, Ben. It's a threat that is really concerns a wider, more global involvement of this war.
Yeah, so I think whenever you talk about a conflict in the Middle East, the vector by which people think that that's likely to affect the world economy, or that could, in a worst case, affect the world economy, is, of course, via energy prices. And we haven't really seen that as you say, in 100 days of the conflict in Gaza so far. But the risk that oil markets have been worried about, of course, was that the conflict could escalate. And I think it's hard to say after 100 days, even though it perhaps, in fact, did not escalate in the way that people feared, it's hard to say that the risk has gotten any less. And when we look at what's been happening in the Red Sea in the last week or so, you could actually easily argue that it's got more. And not only that, but in addition to the biggest risk of all Middle East conflicts, which is an effect on the world economy via oil prices, you now have a very clear risk of some kind of effect via shipping prices also, because we are seeing disruption to a very important trade route, and it's not really clear that anybody can do a whole lot about it.
Yeah, it certainly feels like, every day we see the headlines, we talk about the Red Sea, we talk about, those giant ships, pausing or taking a longer route, a more costly route. But it does feel like as attacks seem to escalate, dare I say it does feel like we're just kind of waiting to see, does it go truly the escalation route, or does folks somehow, global leaders say, okay, we got to stop this before it just, takes off and running. And we really are kind of in a third world war, if you will, even though some might say that we already are there. Hey, I want to go to the Fed because we just talked about it with our TV colleagues. The Fed getting it wrong. It does feel like the markets are kind of pulling back from expectations of an aggressive Fed sometimes. And we keep getting warnings from Fed speakers. The Fed could get this wrong, or could they?
The Fed and any central bank can always get it wrong, of course. Yeah. So what we found interesting when we were looking at the risks from the point of view of central bank policy, particularly was the comparison between the US and Europe, I think, where obviously in both cases you've had very substantial interest rate increases, the kind of policy that should slow down the economy. And in neither case has it really led to the kind of drastic slowdown that you might have expected if you plugged in quite that big a interest rate hike into the models. And we kind of felt that there were two different risks going on in the US versus Europe. And in the US, it seemed that maybe a bigger risk was that just the thing didn't work. It didn't slow down the economy all that much. It might actually start heating up again in ways that the Fed doesn't like. And of course, what we talked about with the Middle East conflict, adding to shipping costs or energy costs, that could play into that too. And so you might have a risk that the Fed that thinks it's done realizes at some point in 24 that maybe it isn't done. Whereas in Europe, you seem to have kind of the opposite risk, which was a central bank that's done a lot, economy slowed down, but did not come to a kind of juddering halt. But what if it's all still in the pipeline? The famous long variable lags of monetary policy. What if in Europe that stuff is still yet to bite in a big way? That is what could lead to a sharper slowdown in Europe in 24.
Hey, Ben, in the piece, you guys mentioned this natural language processing model that captures Fed speaker sentiment. This is cool. What does it show, and how does this work?
It's a kind of linguistic analysis of what Fed people are saying, quite literally, with a weighting attached to various words that they use. It's based on news reports, but based on thousands of news stories that come out with direct comments from Fed speakers. And it's an attempt to gauge, if you could literally measure their words to see how they're, whether they're tilting in a hawkish or dovish direction, based on the use of certain keywords, certain kind of phrases that come into play. What would it tell you? And what it tells you, I think, is pretty clear in the chart in the story, which is that, yes, they pivoted, but the pivot has a long way to go before it actually gets into the area of, we're about to cut rates.
All right, let's get to also one of the largest economies out there, and we're talking about China. 2023, we all thought, okay, that's going to be the year China comes roaring back. It did not. You guys note it still looks a little bit wobbly.
Yeah, the risk of the long-running real estate crisis there, which, of course, in other countries like Japan in the 90s and the United States in 2008, I think it's on everyone's mind that, a real estate crunch can lead to a deeper financial crisis. Hasn't happened in China, and what you've had is a disappointing rebound, but the risks this year, we think, are kind of tilted to the downside in China, and the starting point is not great anyway.
So we don't have time, Ben, to get to everything on the list here, but I want to give you the choice to go where you want to go and what our audience watching and listening right now needs to know about the year ahead. Well,
a couple of, to try and end on a bright note here, since in the piece we basically focused on the things that can go wrong, and obviously there's a lot that can go wrong. It was kind of interesting to look at a couple of economies where you feel like, most things that could go wrong already have gone wrong, which is Turkey and Argentina. And both of them are still facing very, very severe challenges. But just the possibility that those countries might turn a corner, that's been a long time in coming. Argentina, still their inflation rate is above 200%, and there is a substantial risk that it kind of takes off even from there. But after a radical change of policy and with some support from the IMF, it does seem possible that they could turn the corner this year. And Turkey has also done a kind of U-turn away from its very unorthodox policies. It looks now like things might be stabilizing there. So let's highlight those as the kind of the things that might go right.
Final thoughts, 20 seconds. Risks are risks, right? They may not play out, and we need to remember that, right?
That would be the best good outcome, I think, is if none of the bad outcomes happen. Yeah, stuff.
Yeah, the guys are or the individuals in Davos right now are saying the glass is half full. They're seeing a lot of resiliency despite this list of risks.
It's cocktail hour there. That's why the glass is half full. Okay?
Well said. Ben, thank you so much. We really appreciate it. Ben Holland, Global Economics Editor at Bloomberg News, on Zoom from Washington, D.C. This is the Bloomberg Big Take, which you can catch on the Bloomberg, also at Bloomberg.com/Big Take. And you can read more of those stories and other big takes. Always love it. It's a big think piece, which we can apply across
a lot of great year ahead pieces.
A lot of risks.
Yeah.
Maybe cross my fingers, cross my toes, they don't come out.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Well, we talk about it all the time, just how big a contributor it is to the economy. And we're talking about healthcare. Spending on health accounted for 17.3% of U.S. GDP in 2022 for a total of $4.5 trillion. That's according to the Centers for Medicare and also Medicaid Services, Tim.
Yeah, last week we got the numbers from the BLS. Healthcare adding 38,000 jobs in December, second in hiring only to the government. A lot of money.
Yeah.
A lot of people.
Yeah.
When it comes to healthcare in the U.S.
And we get a lot of questions. So we think about how will AI transform this? What about the role of private equity in the hospital and healthcare space? Will it cut costs and, most importantly, improve patient outcomes? We've got a great guest to really take a big view perspective on this. Robert Garrett is Chief Executive Officer of Hackensack Meridian Health. I know the system well. A New Jersey-based hospital network, 18 hospitals, 7,000 doctors in more than 500 locations that provide care. He is also chair of World Economic Forum Health and Healthcare Governors Community. And before he heads over to Davos for next week, he joins us here in the Bloomberg Interactive Broker Studio. Happy New Year. Nice to have you back. How are you?
I am great. Happy New Year to both of you. Great to be back, too.
It feels good to be back. It feels like we're kind of back to normal, as they say.
Sort of, yeah.
Yeah, because we all just get COVID once a year and,
Yeah.
I just had COVID for my third or fourth time.
Becoming a little too routine, right?
Yeah, it is.
It is kind of weird. So let's start with Davos. You're getting over there. You're heading over there. What's top of mind for you?
So, as in this new role as chair of the healthcare governance.
What does that mean? What exactly is that?
So what that is we convene healthcare stakeholders and we decide what the priority topic or topics should be. And as the chair, I have to really convene that group. There's a steering committee. And then I have to actually chair the meetings that actually take place there. So this year, when we thought about all of the topics over the last few years, there was health equity and the inequity that exists in underserved countries versus the Western countries. I think like a 30-year gap in life expectancy as one example. Yeah. Then we thought about healthcare access and not having equal access across the globe to healthcare and healthcare programs. We thought about climate change and the impact climate change has on health, and then we thought about improving healthcare outcomes and adding more value to the healthcare system. All of those, if you think about all those four topics, they all are going to be so impacted by what is really the most profound innovation of our.
Don't say it. Don't go there.
I know,
Don't go there.
I won't. I'm tempted, but I won't.
Every time we say it, you have to drink a shot.
ETFs.
Yeah,
the Bitcoin ETFs providing healthcare.
Right.
Is that what you're going to say?
No.
Yeah.
Okay.
Yeah, the way they say it's the penicillin of our generation. But you know what? So we thought AI really did make sense because it really wraps around all four topics. So the steering committee, we had those discussions. They agreed. And so what's going to happen at Davos is we're going to have a discussion from some of the stakeholders, pharmaceutical company CEOs, as well as device CEOs, device maker CEOs, healthcare system CEOs, as well as insurers, all around the table, hearing about AI, what their take is, where the impacts are going to be, what the pitfalls might be, what safeguards we have to set up. Then we're going to bring in the policymakers. So we're going to have health ministers from different parts of the world come in. We're going to hear from their perspective. Then the policymakers leave the room and the governors get back together and we break out into small groups and we decide what our action plan is going to be going forward. And we leave there not just with what the problems are or what the challenges are, but what are the solutions. And I'm committed as the chair to meet once a month following Davos. So it's not going to be something that's going to be put on the back burner till next January. It's going to be talked about.
Okay, so you've thought a lot about AI in healthcare. Help us understand. I mean, I think a lot of people have experience with ChatGPT and understanding what generative AI can do, but apply that to healthcare space for us. And if you think about the world that you want to see in 5 to 10 years, paint that picture for us. What does it actually look like if AI has helped healthcare?
Well, the first thing I would say, Tim, is really identification of disease earlier. I think that really probably will be the most profound impact, and we're already seeing some case studies and some pilot programs that are indicating potentially some breakthroughs there. At Hackensack Meridian, as an example, we have a pilot going on now that is identifying stage 3 kidney disease earlier, and that has some profound impact, because if you can really identify it early enough and apply some prevention.
But how does it do that?
Well, the technical piece is through algorithms and patient data. They're able to.
So basically, correct me if I'm wrong, the patient will come in and be asked a series of questions.
Correct.
And the answers to those questions would go through some sort of algorithm.
And come back and say, okay, this patient, in 3 years from now is likely to have, advanced kidney disease.
That's interesting, because I think a doctor could do the same thing, right?
Well, they don't always have all the tools at their disposal. This can aggregate imaging. It could aggregate patient data, family history, demographics. It's just a lot for a clinician to really do.
It's almost like having a massive spreadsheet and putting all the endpoints and from different sources and just saying, almost like a probability study, if you will, statistically, and saying you're more likely to have these problems.
And another good example, to your question, Tim, is in radiology and imaging. So a radiologist has to read, an average radiologist in a given day has to read like 150 scans. Wow. Through AI, they're able to then tell the radiologist these 3 or 5 need priority based on the patient's history, the data in the medical record, and the scan itself. You need to pay attention to these because they may need treatment earlier on.
I see.
So that's been really, really helpful. So when I think about AI in the future, I think about some of the clinical outcomes that can improve. There's also the efficiency side too, which is...
Hang on for a second, because I want to bring one element into it, just because we have a headline crossing the Bloomberg. UK Prime Minister Rishi Sunak authorizing joint military strikes with the U.S. against the Houthi rebels in Yemen, and his cabinet approved, according to a person familiar with the matter, as the allies look to deter further attacks on commercial vessels in the Red Sea. So his cabinet approving the decision on a conference call today. Airstrikes possibly as soon as later in the evening, according to those familiar. So we continue to see heightened tensions in the Middle East. The reason I wanted to jump in, Robert, is that I do feel like there's going to be a lot of conversations in Davos about risk that's out there. We've got 2 big wars. You talk to geopolitical strategists and they say, actually, there's about 100 levels of some kind of outbursts or activities, smaller ones, attacks around the world. Some say we are already a world at war. So when you look at the healthcare issues that, yes, are so important to ministers, how are they going to think about prioritizing that, the money, the need, the efforts, when you've got some really serious situations going on right now? I
mean, it's going to be a challenge, no doubt, for even in the U.S., I think, in terms of our budgetary priorities, right?
Right, and even after coming off of a global pandemic that shut the world down,
correct.
It's interesting how things can be put to the side.
But if you think about it, just in terms of even climate change and its impact on health, I mean, that's gonna continue to get worse and worse. I mean, I saw a statistic just the other day that I think between the years 2030 and 2050, 250,000 more people each year will die around the globe because of climate change's impact on health and health care. So we can't ignore those problems as we have these geopolitical crises out there.
But it does make it harder, right, for countries
harder.
And ministers to kind of get their initiatives.
Absolutely, and that's why our voice as a healthcare provider has to get even louder and say, okay, you know what, we understand you're challenged and you have these immediate issues, and there's a war in the Middle East, and we have Ukraine, and we have all these other situations out there. But we can't ignore everything else. I mean, one of the
and just got about 30 seconds, then we'll come back and talk more.
Yeah, just quickly, Carol. One of the lessons from COVID was that too much was probably put on the back burner. Like as an example, in healthcare, people didn't come in for their screenings, and we're seeing higher rates of cancer, higher rates of cardiac disease, higher rates of diabetes because of that. So I think what the lesson learned for me is, hey, you know what? We're always going to have some crisis, but we need to be multifaceted, and we need to pay attention to a multitude of issues.
One thing I want to ask you about money in hospitals. We've done a lot of reporting about it. Private equity owning about 30% of for-profit hospitals. A lot of them are in rural areas of the United States. You guys are a nonprofit, right?
Correct.
What's the difference, and what advantages, disadvantages? Help me understand being a nonprofit hospital.
Nonprofit hospital, you are tax exempt, and you have a mission to serve your communities. You have to have a board that's representative of those communities. So you don't have stockholders or shareholders that you have to report to, and any margin or any profit that we make as a not-for-profit gets really reinvested in the health system, whether that's through capital investments to improve infrastructure or new programs or services, or our people, our 36,000 team members.
So what do you make of all the money that is going into the for-profit hospital system? Because you've seen some of the horror stories. We've reported on it here at Bloomberg. Good or bad?
I think it's a mixed bag is how I would put it. Let me explain that. I think it's on the good side, coming out of COVID, so many hospitals and even health systems were stressed, particularly in rural areas, and they would have closed if it wasn't for maybe some for-profits or private equity coming in and helping to bail it out. The problem, of course, is what's the mission? Where's the priority? I do think that private equity is probably here to stay in healthcare for some period of time. So I look at it as if it's coming to my market, coming to New Jersey, private equity companies, which they have. They're gonna be there with or without Hackensack Meridian Health's partnership. So I actually am looking for ways that maybe we can partner, and maybe yes. So maybe there are some joint venture opportunities where our mission still will stay true, but we'll be able to provide some services and programs and have a partner that can help us provide them. So one example of that is we recently announced a partnership with a company called One Medical, which is, you guys are probably familiar with them. They're part of the Amazon network. They were coming to New Jersey, again, with or without Hackensack Meridian Health. They are a group of primary care providers. We do have a shortage of primary care physicians in New Jersey. So we thought it's best to partner with them to make the One Medical group part of our medical group at Hackensack Meridian Health. And we're able to expand primary care coverage, and we're going to be opening up new primary care centers throughout New Jersey with One Medical. So that's an example of where I think it can be positive.
Do you worry, though, that the interests of a private equity firm aren't necessarily aligned with high quality patient outcomes?
I do, Tim, and that's why I think that wherever possible, if there's ways that we can partner and keep the not-for-profit mission in healthcare, I think that's positive. Now, of course, there's going to be a give and take if you do have a true joint venture. But we would only find, from our perspective, we would only want to partner with a company that shares our values and our mission. But yes, I'm basically, unchecked. I think that private equity may not necessarily have the same interests as a not-for-profit health system.
When you look at the data, which ownership structure has the best patient outcomes?
I still think the not-for-profit hospitals and the not-for-profit health systems have the best patient outcomes that I've seen, and that's patient quality and patient safety data. Now, maybe from an efficiency perspective, some private equity and some for-profits do have a decent track record. So their length of stay might be lower, their readmission rate might be lower, and those are important factors. But what I consider most important are quality and patient safety outcomes.
When you talked about in New Jersey that there's not enough primary care doctors, and I do wonder, I'm going to be a little crazy, but are we getting to a point where it feels like we keep talking, Tim, right, with guests about shortage of healthcare workers, nurses? We've been talking about that for years. Like a little bit of a Hunger Games scenario where it's going to be really rough to find the care and the right people that you need to do. I feel very blessed in New York, but still.
The doctors who I know are so burned out.
Yes.
And they're early in their careers.
Yeah.
The work that they do is so important, but they're not, it's not like, these other jobs where people, now they only have to go into the office 3 days a week. No, you're a doctor. You have to be on site. You're on call on weekends. Like, yes, their compensation is good, but it is tough work.
The burnout actually got much worse as a result of COVID. So when we've done our surveying, we see that, with doctors and nurses. But the statistic nationally is 1 out of 5 nurses, as an example, have left the profession since COVID. And what's even more scary than that is 1 out of 3 in recent surveys are saying they're seriously thinking about leaving the profession. So we already, as Carol said, we already started with a nursing shortage. The one thing that's common to doctors and nurses in terms of burnout is they are burnt out and frustrated with all the administrative tasks that they have to do that take them away from direct patient care. So that's where technology will come in.
When does it come? Because we've been talking about, why can't I just walk in with a card and here's all my information, here's all my latest tests, and just tap it. Yeah. You got it. And it gets updated.
Good luck.
It absolutely.
Maybe that's what we should create.
It absolutely should be that way. But I'll tell you one technology that.
In just about 40 seconds.
Okay, one technology that is coming into fruition now that we're doing at Hackensack Meridian. We're piloting. It's going to be rolled out, and that's virtual nursing. So through remote connections, a virtual nurse can help the bedside nurse, and they can do a lot of the administrative tasks, the things, the charting, the admission and discharge, charting that needs to be done, which frees up the bedside nurse to spend more time with the patient.
To actually care for the patient.
Actually, and we're doing that with physicians too, where they're able to spend more time with patients. That to me should be the major focus.
Well, a million more questions we have. Tim and I really get into the healthcare space, lots of things. So hopefully you will come back soon.
I sure will.
We would
Thank you.
Have a safe trip to Davos.
Thanks very much.
Be well. Robert Garrett, and good luck with everything. Robert Garrett, Chief Executive Officer of Hackensack Meridian Health, as we said, Chair of World Economic Forum Health and Healthcare Governors Community. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm putting all my eggs in one basket.
When we think about baskets of stocks,
We used to think about mutual funds.
we did, but alas, no more.
Now we think about ETFs. And as I mentioned earlier, Carol, this year's already a huge year for ETFs, thanks to last week's SEC approval of 11 spot
Wait,
Bitcoin
we got approval?
ETFs. We did.
Hashtag sarcasm.
We got approval, via a tweet that ended up not being correct. I don't know if you remember that.
What a week it was.
And then the next day, the actual approval came. But there's so much more to ETFs than the shiny new Bitcoin ETFs.
Yes, indeed. Unfortunately, the team that covers ETFs at Bloomberg Intelligence, led by senior analyst Eric Balchunas, who hopefully got some sleep over the weekend, that team, led by Eric, whittled their global list of 24 picks down to just a handful.
The story featured in the year-ahead issue of Businessweek magazine, which is available now on newsstands, on the Bloomberg terminal, and at Bloomberg.com/Businessweek. This story, by the way, written none other than Bloomberg Businessweek editor Joel Weber. Joel's here in the Bloomberg Interactive Brokers studio with us. Also with us is Eric Balchunas, senior ETF analyst for Bloomberg Intelligence. He joins us on Zoom in Philadelphia. Joel, you
know how to write a story?
Yeah, it's amazing.
Oh, come on.
You have time?
Jeez.
You have time for a story?
Oh, come on. So Eric and I co-host this podcast, and we've been doing it for years called Trillions.
You love ETFs.
It's just this thing. I think it's Eric's theory of everything. Like if you could kind of like put the universe into one thing, the ETF would explain Eric and investing and all kinds of other stuff. That's what working on Trillions with him for me has felt like. And so it becomes a really interesting way to kind of, I think, look at finance and investing. And there's just more and more interest in it. We named it Trillions because every year there's more trillions that go into these things. You can still talk about mutual funds. We actually make time occasionally on Trillions to do so. And we also do this episode every year that we have not had a chance to talk about yet. And if you'd like to listen to the whole thing, you can do so wherever you listen to podcasts. But for the year ahead issue, I took that conversation and kind of whittled it down to just a handful. And while we were first talking about it, we didn't have an approved ETF for Bitcoin, for spot Bitcoin. And then last week happened, and it was just like, we got to talk about this with Eric a little bit, as well as some of these other ones. So Eric, I quote you in the story because you say by the end of March, we're going to know who the winner of the race is. SEC let a lot of ETFs out at first. Who's got the early lead?
Okay, so I've separated the 10 launches into what I call the newborn 9 and GBTC. Mm-hmm. Because it's different being a newborn in the ETF world. Joel, as you know, we call it the Terradome. It's a tough industry. So being a newborn is a different playing field. GBTC was a trust that existed, had $30 billion in assets and a bunch of volume, and it converted into an ETF. So it came over with like ammunition, right, and all kinds of supplies into the Terradome. So if you look at all of them, GBTC still has the most assets and volume, but of the newborn 9, BlackRock, no shocker, is in the lead. Fidelity a close second. ARK, Bitwise, jockeying for the third position. But a lot of them are doing well. Like if you look at the volume of even like the least traded one, which I believe is the Wisdom Tree, it did $10 million in the first 2 days. That would be a big hit, a big day for any regular new ETF. So the lot of them have traded over $10 billion in the first 3 days. Unbelievable action in these ETFs. But BlackRock looking like the early favorite to be sort of the GLD of Bitcoin, but it's got to overtake GBTC, which again came in with all this assets and volume and still has more.
There's a story though on the Bloomberg that talks about investors pulling over $500 million from the Grayscale Bitcoin Trust during the first days of trading as an ETF. Is that significant, or how do you read that, Eric?
Yeah, so this is a big situation. So the newborn 9, all the volume is inflows pretty much because there's nobody with shares to sell, right? Because they didn't exist.
Right.
So the GBTC, however, are people who probably want to get out. Now, that said, you have to take a tax hit if you want to get out. So I don't think all 26 billion as it stands now are going to get out. But there could be some people who want to get out, take the tax hit. Now, it's a long story short, but they can't go right into the new ETF. So that's why I think a lot of the new funds into the newborns are new money. Some maybe GBTC refugees, but over time, I do believe GBTC will be like a slowly melting ice cube, and the newborn 9 will build up. And at some point, they'll probably be they'll both settle a little bit, but there is an interesting dynamic of play that you don't normally see. And so, if I had to guess, I'd say GBTC sees, 4 or 5 billion of outflows in the first couple months, and then kind of settles down.
Isn't it bigger than an ice cube, though? It's like more like a glacier.
It's a glacier. Yeah, 26 billion. I mean, I believe that makes GBTC like the top 3 biggest holder of Bitcoin on Earth. So yeah, it's amazing. A total glacier.
Yeah. But, glaciers face climate change. Yeah, yep.
Hey,
sorry.
Welcome
to Trillions. Sorry
to derail the show, guys.
Radio Eric, is quicker than podcast.
This isn't Trillions, the podcast.
Eric, I got a question. I'm curious if you look at the 11 different spot Bitcoin ETFs, should they all have the exact same performance every single day because they're tracking the exact same thing, like VOO and SPY, for example, that track the S&P 500? Shouldn't they have the same performance?
Yeah, it should be very close. The only thing you might find differences is what the premium discount, the price to the NAV. There's been like, I don't know, a 30 basis point swing between them. But again, these are minor points. We were a little worried that the price and the NAV would be a little further apart, which is a sign that arbitrage and the mechanics of the ETF were more difficult because you can only do cash creations. Long story short, everything looks pretty good. So the dollars you buy it at, like I think IBIT started at $25. Another one might be trading at 50. But the percentage day on each that it changes each day should be pretty much lining up minus 10, 20 basis points.
You know, the other thing that I wanted to ask you about was trading volumes, because I thought that was a really interesting insight here. You said don't look at, you know, assets under management, and obviously GBTC is representative of that. But why are trading volumes the thing that you all are watching as you evaluate these newborn 9?
Yeah, because volume. You need two things for a new category to have long-term growth. You need volume and you need low fees. These have both, because we already saw the fee war breakout. You can get them all between 20 and 30 basis points. That's
even
pretty
before
good.
They were approved.
Even before. The fee war happened before the race even started. Again, wild stuff. The volume is crucial because when you're an investor, an ETF investor, whether you're an advisor or an institution, volume is like a party with people there. No volume is like someone who invites you to a party, but there's nobody going. And it's just the general way. You don't need volume to buy an ETF, but people just like to see liquidity. And so when liquidity forms around these ETFs, and it's hard because it has to grow naturally. Assets you can just shove in there, but volume only grows in nature. And so it's harder and more coveted. But once you get liquidity, you get more liquidity, because liquidity attracts the bigger fish because they like to go in and not have impact costs. So as you get more and more liquid, you get bigger and bigger fish and more liquidity. And I think the volume, the start that they're off to is really, really good. It shows that you will find a comfort level to any investor pretty quickly. Again, I got the low fees, I got the liquidity, and I'm off. And get this stat. I just ran the numbers. Of the 500 ETFs launched last year, these Bitcoin ETFs are already averaging 3 times what all 500 of those traded today. So again, the numbers are just outrageously high for these products.
Okay, so do you want to keep talking about Bitcoin ETFs, or do you want to talk about other?
No, let's
ETFs?
move on.
Okay,
They're going to send me the psych words, Joe.
Amazingly, there are other things.
Interventions are coming for me. I know it. My friends, I can hear them talking behind my back.
Okay, I want to talk about the small caps ETF, CAF, and why that's been an interesting one that stuck out to you.
Yeah, because small caps were left behind last year and honestly a lot of the last decade. And here's this small cap ETF, CAF, that did better than the S&P last year. So that just blew my mind. How can a group of small caps actually beat the large caps? And the way they did it was it's an ETF that looks at cash flow. And by looking at cash flow, you get to more quality small caps. You get to the quality factor. And the quality factor was the best of all the quantitative factors last year. So it was enough to lift it above large. So I thought it was interesting. Also, this ETF has seen flows for the past 44 months. It has decimated the Russell 2000, which is its index. Like I said, it beat the large caps, so you know it's decimating the small caps in general. And I think when people think of small caps this year, the big word on the street is it's time for them to play catch up. Well, here's some that already are off to a good start. So we wanted to look at it. We also wanted to know if it could keep these flows going, because these kind of flows for an ETF that's like indie, like not a big 3, are really unusual. And so it was also an indie feel-good hit of last year. So that's why I chose it.
Okay, for my transition to the next ETF, I want to bring up a news story that was just published in the last 15 minutes or so. Blackstone's defaulted NYC office loan is for sale at a 50% discount right now. We're certainly seeing some stress when it comes to commercial real estate as the return to work, despite all of Joel's best efforts to get everybody in the office.
Ongoing propaganda campaign.
It's working for me, man.
Yep.
There's a way to bet. There's a way to bet on returning to work. Eric, how do you do that? With a desk is the ticker? That kind of makes sense.
Yeah, this was a classic thematic ETF. My colleague Athanasios chose it. So this is the VanEck Office and Commercial REIT ETF. And basically, this is a play on return to office. Commercial real estate has really lagged the real estate stocks in general, or the index for real estate stocks. So here you have a laggard, and you have a trend of like all these companies wanting to get people back in the office. And so, that we're interested to see if this thing sort of plays catch up, because even if the real estate index is flat, if this plays catch up, you get a bump. Plus, it was a novel way to slice and dice the real estate market. So it's got Boston Properties, Vornado are the top two holdings. And a lot of people use Vornado as sort of the proxy already for the return to office. So that's the top holding. So you get a lot of that stock in there as well.
I think it's just interesting. Like, I can't speak to the Blackstone story necessarily, but there has been this perception that, commercial real estate is down and out, and no amount of RTO can help it. But like slowly but surely, like there's at some point it becomes like, wow, maybe this is a contrarian investment opportunity. And what's amazing about that ETF, which is brand new, it's like ETF can take a whole trade and just like package it into a ticker that you can trade like a stock.
If we get a lower rate environment too,
it's incredible,
right? It would make it much easier for this space.
These firms, yeah.
Yeah.
Okay, here's another interesting one, especially off of last year where you had this magnificent seven and the tech companies just ran away with it, Eric. What is Athanasios put forward as another way to think about tech perhaps in 2024?
Yeah, so this is the Invesco S&P 500 Equal Weight Tech, RSPT. So equal weighting is a way to sort of like take out any kind of imbalance in your index. And so people like it, whether it's the S&P equal weighted. This is tech equal weighted. So you get all of the big magnificent seven, most of them, but you get them at 1% or 2% weighting each. So you get a little bit more of an overweight to the tech stocks that haven't done so well. So overall, we're calling this sort of like the methadone version of the Qs, right? And there's many ways to do this. Many people are figuring out how to get off of the sort of reliance on these seven stocks, yet they want to stay invested in equities. So we've got NASDAQ covered call is a way to do it. You've got equal weighting is another way to do it. Mid caps are another way to do it. So we think there'll be a movement of flows away from the market cap weighted indexes a little bit this year to these types of less magnificent sevened up ETFs.
Still get the tech, but just, that equal weighting kind of makes it all
fair,
equal, obviously. Yeah.
Equal.
And then...
Oh, I mentioned if we actually get a Fed that cuts rates here, there's a treasury play here.
Yeah, this is TUA. This is designed by hedge fund people who started a company called Simplify. And I like it because these products are really interesting. This is almost like 5 times leverage short end of the curve. So because you're short end 5, it's not that much. But it's a kind of a strategy that you might find PIMCO doing for institutions or a hedge fund. 2 is the ticker, and this company has gotten a lot of actual institutional investors, which is rare for a small company. And so I like to highlight it because a lot of ETFs, they don't just package different asset classes, they package like people. I mean, these are hedge fund brains designing funds, and TUA is their biggest hit so far. And if the rates fall, this should pop.
Hey, Eric, make sure to tell your friends and family you talked about stuff today other than Bitcoin ETFs, okay?
Yeah. My name is Eric Balchunas.
I'm sending this clip. Hopefully they turn it to a clip. I'll forward it to my friends.
Okay, good.
You definitely sound like you got sleep, so really good stuff. This was so much fun. The two of you are pretty...
we should do a podcast.
It's called Trillions. It's
a good one.
The podcast.
Eric Balchunas and, of course, Joel Weber. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Chip design company Synopsys agreeing to buy software developer Ansys for about $34 billion in a cash and stock deal. Marking one of the largest deals announced worldwide in the past year. I just want to point out that Ansys shares were down 5.5% today. Synopsys was up 3%.
Yeah, maybe because the deal for Ansys came in below prior reported levels. That's according to some analysts who we spoke to here at Bloomberg News. Secondly, Carol, Advanced Micro Devices, AMD, shares rallying, outperforming the stocks big time. The chipmaker trading at its highest in more than 2 years as Barclays raised its price target on the stock to $200 from $120, seeing AI as a primary driver of growth.
Basically saying it's not just about NVIDIA because maybe they can't do it all. I do want to point out
AMD's pretty happy about that.
AMD, number one gainer in the S&P 500 and the NASDAQ 100. All right, so let's get into it with Bloomberg News Managing Editor of Technology and Global Cybersecurity here at Bloomberg News is Lynn Dewan. She's here in our Bloomberg Interactive Broker studio. A lot going on. Let's first talk about the deal. These are not companies that I feel like when we talk about semis, do we typically talk about these two companies? Tell us about them and what we need to know.
No, nobody knows about these companies outside of these walls.
Okay,
We're the
I'm
experts.
so glad you, can I just say I'm so glad you said that?
We're like,
because
who? What?
I'm like, okay, this is a $34 billion deal. And yes, there have been mumblings about this over the past week or so.
Yeah.
And I was like, I should know about these companies. This is a big deal.
Synopsys was up 61% last year, by the way.
That's right. It's a good gainer. I mean, there's good reason, right? So Synopsys owns this very specialized part of the chip supply chain, which, as you know, is critical to the world. Chips are in everything. They're in televisions, they're in refrigerators, they're in cars, they're in like AI, compute, and Synopsys doesn't make the chips. Synopsys doesn't even make the chip machines that make the chips. Synopsys makes the software that flows into the machines that then makes the chips. And there are very few companies that are in that space. So they already have a really good market share in there. And this investment, this $34 billion deal, what that does is it increases their stack, so to speak, in the technology world. So they're not just designing the software that makes the chips, but they're able to now integrate this company, Ansys, that builds models that allows manufacturers of everything from cars to like aircrafts, defense devices, and military equipment to model how that equipment is going to be used in the real world. So imagine taking this like chip design company and merging it with this modeling software, and you have like a very powerful combination that can go after even bigger market share.
Kind of a one-stop shopping, it feels like.
That's right.
Companies.
Yeah.
You need your chips, Carol. You know where to go, right?
Yeah, we do.
You do all your chip shopping there.
Yeah, last time I went chip shopping. But it's wild. It's funny. I love the supply chain analysis function on the Bloomberg. And Ansys, I mean, customers are Caterpillar, Boeing, Rolls-Royce, Lenovo, Huawei.
The military.
All of them, right? And then I'm looking at Synopsys, and I'm looking at a lot of companies that I don't actually know.
Oh, well, you just mentioned AMD. AMD, right?
ARM.
All the major chip manufacturers of the world are going to use a company like Intel. That's right.
And Ansys is
I'm going down the list now. I see them.
Ansys is a customer.
They have a
Synopsys.
years-long relationship with each other. What they would say, and I think they said it during their call earlier this morning when they announced the deal, is that this is like years in the making. Like they have been using each other's technology for quite some time.
Regulatory problems, regulatory issues?
Right.
Because
so
it was interesting. Synopsys rallied, which was the acquirer, which is not what you typically see. And then Ansys as the target went down.
Both moves are counterintuitive.
Yeah.
To some extent, exactly what you mentioned, which is the fact that like the price it's going for is less than what the market had expected. There were some reports, not from us, there were some reports out there about the fact that Ansys could end up going for like $400 per share, and it ended up going below that. So that's one reason, but another reason is exactly what you said. So another reason, of course, is the regulatory concern over having these two companies merge together. That's a pretty powerful market force, and whether it gets past the CFTC and other regulatory agencies, we don't know. And then there's the geopolitical pressure of China. Right? Will China, a big consumer who has a say in these kinds of mergers, even if they're two American companies, sign off on a deal like this that would create a powerful company within here, within these bounds?
That's surprising to me. Why would China have a say here?
It's super surprising. I didn't learn this until like another deal that involved two other technology companies ended up falling apart earlier this year. China is a major consumer of all things around the world. Because it has huge buying power, it actually has say and influence and approval processes in place for mergers of companies that serve the country.
That's interesting.
Even if they're outside of the country.
So I did the FAGO function on the Bloomberg terminal, literally FAGO. And what you can do is you can pull up the financial analysis by geography, and you can see that In fact, for Synopsys at least, 15.2% of the company's revenue in 2023, the fiscal year ended in October, came from China.
That's exactly right. And actually, in an interview with Bloomberg Television not too long ago, Synopsys even said that the then outgoing CEO of Synopsys said, we would be selling even more to China. China would represent an even larger share of our market if it weren't for the restrictions that the U.S. has placed on exports of chip technology and chips themselves to that country.
And it doesn't look like Ansys gets a significant portion of revenue from China at this point. It's not
but
even
it will.
considered.
Yeah, right.
Yeah, good
so
point.
once it's a part of the company.
I mean,
Exactly.
for Synopsys, it opens up a ton of different markets for them, right, that they haven't already played in. So I don't know, net, how are you thinking about this? Is this likely to happen, or we're going to have to be patient, or I don't know. How do you think about it as an analyst? I know you can't say yes or no in terms of it's going to happen, but
so
I don't
hard
know.
to call whether it's actually going to happen, but I'll point you to two things. One, there was a very large merger in aviation today that faced some antitrust pushback.
JetBlue
Blew
and
a few
Spirit.
hours ago.
Talked about
potential acquisition of
right,
Spirit,
right.
yeah.
But on top of that, I will also point you to the
Because it was
estimated-
they were concerned about anti-competitive. Would this be anti-competitive?
That's the question,
Okay.
right? And they raised that as like a potential concern as part of their conversation today with investors. But the other thing I'll point you to is the estimated closing date of this deal is the first half of 2025. In the market's mind, that just points to the fact that they are anticipating a potential fight.
You never want a deal to take a year to close. I mean, even from selling a condo, somewhere in the U.S., a realtor is going to say to you,
a long time.
"Let's get this thing closed as soon as possible because the longer we wait, the more this deal can fall apart."
Raising my hand.
Yeah.
We do have a election here in November.
Are you raising your hand because you want to talk, Carol?
Well, yeah.
Okay.
Is it the expectation
You can
that
talk.
About
we'll,
that election,
we'll get
yeah.
through an election, we'll have a new administration? Is that part of it?
That's an interesting strategy. I hadn't even thought about it. Will we be ushering in a different CFTC that is more like merger friendly? I don't know. It's not like the Trump administration was.
Both of them have been
Right?
pushing in terms of
Exactly.
China, but you never
So,
know, right?
Yeah, that's a dangerous game to play if that's the reason why they're scheduling the closing for first half of 2025.
I don't know. It's just weird. It's a long time. Quickly, can we move?
Yeah, go ahead.
Can I talk?
You can talk. Yeah. Permission
Raise my hand.
granted.
I'm giving you permission.
AMD, number one gainer in the S&P 500, the NASDAQ 100. I loved what Barclays had to say. And part of it was, I lost all my notes, but basically NVIDIA, yep, it's been the chip company we talk about when we think about AI, but basically saying maybe they can't do all of it. Like the ecosystem that AI is creating, that you're going to need more players.
Why are you
maybe
shaking your
AMD.
head?
It was always a crazy phenomenon to me that only NVIDIA would enjoy an AI bump. It was so
Love
crazy
that.
because we would throw all these other chip companies out there like, hey, remember AMD? Remember, all of these other companies that also, and for some reason NVIDIA was just eating up all that. I mean, they have first mover advantage, but first mover advantage only takes you so far. At some point, others crowd that area and you have to figure out how to continually innovate. And you just had AMD come out with this new NVIDIA chip rival.
Right.
Like it was only a matter of time before everyone woke up to that. I'm just a little surprised that it took that
Barclays
long.
said the desire to have a second source will overwhelm difficulties for the software ecosystem. Is there anybody else in addition to AMD that you think we should be watching in terms of the chip
As
space?
in, is there any money that should pile into any other financial stuff?
I know you can't tell
I won't
people,
touch it. I
but,
won't touch
but
it.
should that we have on our radar?
Maxim is another, chips company that comes up every once in a while. I will leave it there because I don't want
Okay.
anybody to end up trading
Yeah.
on my stock advice. But there are others in the space, and frankly, ARM is a publicly listed company right now. They marketed their IPO on the hopes of an AI bump. So there's another one that could be a potential play.
Our producer is right. We have to have you on. That was great. Thank you so much.
Oh.
Bloomberg News Managing Editor of Technology and Global Security, Lynn Dewan. Thank you so much, Lynn.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including top travel destinations this year. And folks, it's not only about people heading to Italy. Not that there's anything wrong with that.
Plus, speaking of travel, for all you ski buffs out there, we speak with ski legend Bodie Miller about his new ski company that could jump turn the entire ski industry.
And we revisit the most anticlimactic New Year's Eve of them all, Y2K. We're taking a trip, back to 1999.
And speaking of trips, first up this hour, this week we headed to California Forever. It's a massive project funded by a bunch of billionaires. You'll know their names: venture capitalist Marc Andreessen, LinkedIn co-founder Reid Hoffman. They've all spent about $900 million together to buy 62,000 acres in Solano County, California. It's just northeast of San Francisco.
And full transparency, they haven't built anything yet, but their plan is to create a new city that's self-sufficient and sustainable while addressing the Bay Area's dire housing shortage. The vision is a walkable community, so easy peasy, right, Tim?
Oh, yeah. Development in California, always so easy. Not so fast. The plan has sparked fierce opposition from local residents, farmers, and politicians who accuse the developer of using shady tactics and suing those who stood in the way.
Writing about it in what was a most read story on the Bloomberg this past week, Bloomberg News California Bureau Chief Karen Breslau, who joined us from her car.
I have pulled over. I'm across the street from the future city, which is now just these enormous wind turbines. It's actually a beautiful day out here. It's been raining, so everything's green and the sky is blue and the wind turbines are turning, and it does look quite idyllic.
So piece of cake. They can build it, no problem.
It's 19 degrees. It's 19 degrees where we are.
No, we kind of don't like you right now, Karen, but that's okay.
I'll keep it to myself. Okay.
No. So tell us about this project. Give us a little bit of the who, what, where, and why, just for those who might not be familiar.
Sure. So we are in Solano County, which is of the very exurbs of the San Francisco Bay Area. This is still a largely rural community, some subdivisions. And we're about halfway between between San Francisco and Sacramento. And this area became a subject of fascination, Solano County. In the last few years, a mysterious land buyer started snapping up parcels of land for often very inflated prices. And nobody knew who this individual was or individuals. They were operating under a mysterious name, Flannery and Associates, which is just taken off a street sign in this county. And they were basically, the investors were outed last summer. It's all the bold-faced names you mentioned. It's Mike Moritz, Lorene Powell Jobs, Marc Andreessen, Reid Hoffman, a who's who of Silicon Valley investors. And they poured what we now, so far $900 million into a as yet unseen new city that will be, literally is supposed to be, stood up in what are now, fields used for grazing and wind power. And the idea is to build this green new city. It's part of the new urbanist movement, which is to have walkable neighborhoods. In introducing their plans today, the developers, the planners talked about creating what sounds like a dream to most Californians, which is a place where you can walk to anywhere you want to be in any given day in 10 minutes. So that could be your job. It could be your child's school. It could be a library, a barbershop, a cafe, or your place of employment, or your own small business.
It's very Lefrak City. Like, I think about that concept back, right? Like, Sam Lefrak and I, across the water from here, in Jersey City, downtown Jersey, that whole idea that Lefrak did the same thing, the family, this whole Newport area where you could live, work, there are schools, everything you could easily get to.
But Karen, talk about the opposition.
Exactly.
Yeah, talk a little bit about the opposition and how this is going to a vote now.
Yes. So there are the reason that the opposition is very important is because in California, and particularly in this county, it's governed by a land use measure that was designed in the 1980s to prevent sprawl. And so none of this land is zoned for housing or manufacturing or technology or any of the things that the planners would like to have. So they have to go to the voters and get their approval to change the county zoning regulations. The problem here is that they have alienated already some key constituencies. One would be, the farmers who comprise a large part of the population here. And as you mentioned in your intro, the organizers, the developers have sued several of the farmers, claiming collusion and price fixing simply because they wanted they didn't want to they wanted a high price for their property once they saw that the farmer next door got more. So it's kind of supply and demand. So there's a very contentious lawsuit. They've also terribly irritated two local members of Congress, John Garamendi and Mike Thompson, who represent this area. That are very close to Travis Air Force Base, which is the largest Air Force base on the West Coast and a key gateway to the Pacific. So there were some national security concerns when they were in stealth mode. And then the conservationists in this area are wondering, why would you not infill the existing small cities in this county rather than carving a brand new one out of farmland? They're accusing the developers of creating sprawl or planning sprawl rather than, this utopian green city, which is what they unveiled today.
These are venture capitalists. They're used to putting money into things and making an incredible return. Is that the plan for this city? I mean, cities are public good. They're owned by the residents. They're not owned by anyone. How does the governance work here? We have about a minute left, but explain how that would work here.
Yeah, so the planner of this whole operation is a 36-year-old guy named Jan Schramek, who's originally from the Czech Republic and has spent some time at Goldman Sachs, some startups, has the Silicon Valley thing going on. And he it keeps saying, my investors, this is patient capital. Well, if there's one thing Silicon Valley isn't known for, it's patient capital. But Schramek, it's the planner. He's talking about, a 50-year time frame before this community is fully built out. And so this is not, he said, I hope I'll retire off of this project. This guy's in his 30s. So the time frame for building a city, in history, it's centuries or millennia. And in this case, they're talking about 50 years, which is pretty fast by city building standards. But I think that is really one of the unanswered questions is what kind of return on investment are they expecting and what is the time frame? Is it to prove a concept, which is that we can go back to the future and recreate walkable American cities like we saw, in the early 19th century? There is a kind of a nostalgia piece to this when fused with green energy.
Karen, we would love to talk to you forever. You got to come back, get back to your reporting. We really appreciate you joining us. Bloomberg News California Bureau Chief Karen Breslau joining us from Solana County.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Well, airline stocks falling for yet another day. This after they got absolutely hammered on Friday. Back then, Carol, the S&P gauge of airlines declined the most in 19 months. United fell more than 10%. Delta fell 9%. American Airlines fell 9.5%. This all a result of Delta lowering its profit forecast for the full year, which really underscores the challenges the broader industry faces when it comes back to recapturing that pre-pandemic performance.
Yeah, like you said, the group overall down 7.6% on Friday, down another 1.3% in today's session. All right, so concern lingers even after what was the busiest day ever for U.S. air travel just a few months ago. We're talking about the Sunday after Thanksgiving. So, all right, what's going on?
Yeah, Haley Berg is back with us. She's lead economist for the travel app Hopper. That app analyzes trillions of data points, i.e. prices, on flights, car rentals, and hotels to make predictions about how much tickets are going to cost. Haley joins us on Zoom from Boston. Haley, good to have you back with us. So what gives here? Because Hopper says that more than 3/4 of Americans are going to spend the same or even more on travel this coming year. So why are we hearing the gloominess when it comes to airlines?
One of the biggest sticking points for prices in the last 3 or 4 years has been supply. There have not been enough seats to book. And that's why fares have been so incredibly high over the past few years. Think back to summer 2022, domestic airfare, the highest that we had seen in all of our history at Hopper. So supply is now exceeding where it was in 2019. A lot of it is exceeding now on international routes. So part of this is just the equation of travelers are looking for low prices. There are more seats available to book, so they have more options. A lot of those options are low-cost carriers who may have entered or expanded in the last 2 years. All of that is putting downward pressure on prices, despite the fact that 50% of our users at Hopper are expecting to travel more this year than they did last year.
Is that true domestic versus international travel?
Yes, we're seeing a tremendous amount of demand for international travel, especially among younger travelers. And they're not just hitting the London and Paris of the world. They're really going to more off the beaten track destinations where there might be deals or just more unique experiences. So still very strong demand on international. Capacity there has been slower to recover.
Okay.
Prices to Europe are recovering because we've seen capacity added back there. Prices trans-Pacific, very different story. They still remain 30 to 60% higher because capacity has been slow to recover there.
What about when it comes to other parts of the travel experience, hotels? I couldn't believe how expensive hotels were in the fall when Carol and I were traveling. But it was I couldn't believe how expensive it was. What's it going to look like this year?
You're not alone in feeling like accommodation prices have been incredibly high. They have been. And we're expecting them to stay about the same this year. If we do see improvement, it would probably be towards summer or the second half of the year. But yes, demand for travel remains high, and that means that hotel stays, vacation rentals, especially in those peak markets, they're selling out. And that means that if you're not booking far enough in advance, you're probably seeing an incredibly high prices. What we always recommend is for hotels in particular, if you're headed to a big city, book at the last minute. That's when those perishable rooms are going to go on sale. If you're headed to a leisure destination, you're going to Miami, you're doing a spring break trip, book that very far in advance, couple months, because that's when prices will be lowest, when that availability is still high.
What are you looking at, Carol?
No, I'm just kind of, I'm thinking.
What are you thinking?
No, it's just interesting. And I just wonder, what you're seeing. We've got a great chart for our folks who are watching on YouTube and our streaming service. I'm just not sure. So if you're, basically it says, if you're thinking about the main vacation plan you want to take in 2024, and this comes courtesy of our Bloomberg Intelligence team, if the cost exceeds your planned budget, what will you do? 12% are going to look for a cheaper destination. 15% are going to look, I guess, at attractions and maybe what they're spending there. 45% will increase their budget. So almost half.
And if you're just listening to us and not watching, the 45% is like, the possible changes if your budget exceeds plan. The majority of people, or almost the majority of people, almost half the people said they'll just increase their budget.
Yeah.
I mean, that's bullish.
But it's bullish. But it's also interesting when we just did a story about where if people found that they had a 10% bump in income or something.
Yeah, they pay down debt.
They're going to pay down debt. So help me. Are you talking about, I don't know, what are you seeing? Higher end traveler, bigger pocketbook, lower end? Is there any differences?
There are a few things happening. So our Hopper users are primarily Millennial and Gen Z, and 77% of them say that they are going to spend the same or more on travel this year. And there's really two schools here. One is our millennial generation. They've built wealth. They are coming out, many of them, of a few years of savings, those who were in advantageous positions headed into the pandemic. They are spending more on travel. A larger proportion of their wealth is going towards trips, vacations. They have credit cards that allow them to gain points. The more they book, they are loyal. So this group is absolutely spending more and traveling more. And then on the flip side, we have incredibly price-conscious travelers, more on the Gen Z end. And what they're doing is they're taking their travel budget and they're saying, can I get 2 trips out of my budget from last year that might have been 1 trip? And we often see this. Travelers are skipping the trip to Miami and they're going to a destination in Puerto Rico that might be a whole lot less expensive, both flight and in-country expenses. So there is some optimization within the budget that's absolutely happening. We see that a lot among Hopper users because they're very price sensitive.
Okay, very briefly, we have top domestic and top international locations. Your top domestic locations, we got a list of them we're about to show on the screen. Which one sticks out to you of these 5 here?
I would say that Orlando is always a big one. It's popular not just for those Disney trips, but also for Port of Orlando, starting on cruises, which, as we know, are coming back, in the last year or two. So Orlando's always a big one, in part because no matter how much demand we see going there, prices are low. It's an accessible and affordable place to visit.
And international, your top international locations: Cancun, Mexico, Dominican Republic, London, England, Rome, Italy, Tokyo, Japan. That's kind of a mixed bag. Just got about 15 seconds left. Any thoughts on that?
Those tropical destinations are inexpensive alternatives to some of those longer haul trips, but really this year is going to be all about Tokyo and the return to Asia.
Wow. That's cool to hear.
That's interesting. Where are you going?
Me?
Yeah.
We don't have anything planned. I'll probably go to the American West.
Oh, that's what you said that earlier. All right, Haley Berg, lead economist at Hopper. Thank you so much. That was fun. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business App, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, each fall, Bloomberg Pursuits does a ski takeover. They highlight where to ski and what gear to use for the upcoming season. So in last season's takeover, we sent Business Week contributor Gordy Megros to try out some skis from a new company called Peak Ski Company, based in Montana, co-founded by ski racing legend Bode Miller. So here's what Gordy wrote after spending all day on the skis, Carol. Typically, skis require a certain amount of speed and pressure to engage the tip and initiate the turn, but these carved without having to apply that force. At speed, on the steeps, they held the turn like a race ski, and in bumps and slush, they were quick and forgiving. Not once did I feel off balance. He continued, anybody could use these skis. Beginners would love them because they're easy to turn. Experts would too, because they still can ski aggressively and feel solid underfoot.
It's a great feel of what these two gentlemen are up to. So let's talk more about the skis with the co-founders of the company, Andy Worth and Bode Miller. Andy, also CEO and president of Peak Ski Company. He joins us from Bozeman, Montana. Bode, by the way, of course you know him, Olympic and World Championship gold medalist many times over, and the Chief Innovation Officer at Peak Ski Company. He joins us on Zoom from Big Sky, Montana. Guys, so great to have you here with us. Bode, let me start with you. How did this all come together to create Peak Ski? And why did you want to do it?
Well, I've been obviously in skiing since I was real little and had exposure to a lot of different companies. Started on K2, then Fisher, then Rossignol, then Atomic, then Head for 8 or 10 years. So being in the race rooms and seeing the economics, the way the ski companies worked and the challenging aspects of the construction methodology was kind of frustrating for me. It's pretty analog, and they're sort of stuck in a lot of ways. We didn't really change much in the ski world. We were changing skis all the time, prototyping, but just watching what was happening in the consumer market and then sort of understanding the business model of those companies as I was with them, it seemed really unlikely that I would go into the hard goods side of the business. I know Andy felt the same way. We both kind of came into this as skeptics or contrarians. But as we dove into it a little bit more, I mean, I always wanted to bring better skis to the consumer market. There's a big gap between World Cup skis and the rest. And World Cup skis, granted, are specifically designed for racing and hard snow, really smooth, perfectly prepared hills, which obviously wouldn't apply as well to your consumer just because the hill's always a little messed up, puffs of snow, and
right.
Nothing is manicured like we get in World Cup. But my goal was to bring really good skis to the market. And then as Andy and I evolved through this, I had a connection with a company in Germany, a good friend of mine, and I'd always wanted to sort of modernize the manufacturing process. And I don't know that Andy and I would have done it had we just had the model of doing what we're doing right now, which is, building skis and selling them direct to consumer. It's a fine business, but the scalability is a little bit problematic. In this case, the real sort of enticing part was re-engineering the manufacturing process so that instead of 45 minutes to build a ski and its glue, and they, for those of you who don't know, it's a bit like making a sandwich. They call it a sandwich construction. It's a lot of different layers laid up with glue or pre-impregnated with glue, and then you compress it and cook it in a press. It takes about 40 minutes or so right now, which is why they've been building skis for next winter already right now, because that's how long it takes to build 1 million pairs of skis, say. And we have a manufacturing process that we're in the works on, where we can build a ski in somewhere around 10 seconds and no glue. So we'll be able to recycle it. The same machine that it constructs it will take it apart, and we can retask those materials. So that was the part that really got us excited. That was sort of the why of doing this.
I want to talk. I want to talk more about that. But
that's where the home run is.
I want to bring in Andy Worth here because he's a many-year veteran of the ski industry, having run some huge mountains here in the U.S., Squaw Valley for many years, worked at IntraWest before that. Andy, talk about the the business here and the financing of this. It's a little confusing to me about who the investors are and who you raised money from and how much money you've raised. So give us the details on the business side here, and the reception that you've gotten from as you go out and try to raise money for this.
Thank you very much for that lead out. I should have thought you guys were going to refer to Gordy's article on us. We were recipients of that in November pleasantly, and certainly a respected writer and certainly writing for Bloomberg. That's a great lead out. Relative to the business, as Bodie mentioned, we were both retired about 4 years ago. I worked in the private equity world and also running a bunch of ski resorts, as you know. We came out this business with a contrarian approach, is the understatement. Skeptical in many ways, but after doing a great deal of research and realizing that what Bodie had in his mind was something that could provide an exceptional product, new type of product to the market. And we had these strategic initiatives on which we were working. And we commenced building the company, standing it up, so to speak, and launched in April of last year. And Tom, to your point, we had established an initial pre-cash valuation based on pro forma EBITDA on a 3-year basis and pretty contemporary multiples from what I was able to glean from other companies. That pre-cash valuation was $13 million, small company. And then we completed a $8 million raise about 3-4 months ago, so post cash 21. And in this case, we're currently raising funds through Republic Capital, which is crowdfunding, basically a safe note, and it has our enterprise value at $35 million. The reason being, Tom, is we have a clear line of sight now on these strategic initiatives. The core of the business are the skis, and that's what prompted and supports that initial fundraising effort and the valuations to which I mentioned, or that I referred to. In this case, we're starting to get a clean line of sight on the 3 strategic initiatives, which include technology integration. It's extreme innovation across all levels, but technology integration through Peak Locate, which is this proprietary device we're inserting in the skis.
Wait. But we're Bloomberg, so we get a little wonky about the financial side of it. So it's interesting. So do you guys continue along these ways? Is there venture capital money also in it? Is the goal to eventually go public? Like, how do you think about it, Andy?
Yeah, no, great question. Of course, and not surprisingly on this format, but I think really we're focused on right now is advancing on these strategic initiatives, and then lessons learned in other acquisition environments in my old career is we're going to advance on these initiatives, and we think we can get to the point where we can generate substantial value for our current investors and investors coming in through Republic in this mechanism. We can't speak to any exit strategy because we're focused on execution right now.
Yeah.
But we know that we can take the value of the business right now, $35 million, up substantially from here.
Well, it's interesting. And Bodie, come on back in, because Tim and I were talking when we were prepping for this, because Tim's a skier, really into this. Were you guys profitable? Like, it can be hard to go up against the establishment, and you learned a lot about the industry and the mechanics, and kind of, I love what you said, the economics of the way ski companies work. You probably learned a lot about it, which can be tough to go against, though, also. So I'm just curious, were you guys profitable in the first year? I mean, how are you looking for about it? And we've got about a minute, and then we're going to come back and talk some more.
Okay,
yeah,
Carol,
I think,
the answer.
Go ahead,
Bo.
The typical sales channel that everyone's locked into is really the problem. So Andy and I addressed that by going direct to consumer. Profitability, we ended up not being profitable year one, which, was frustrating, but also, given the nature of startups, was not terribly surprising. But the margins are really good. When you sell direct, obviously the margins are much better. You don't have to sell 200,000 pairs of skis to be breaking even. So, I mean, Andy, I'll let you fill in, but the really positive stuff we took out of year one outweighed the fact that we had some quality control issues and just, I guess you'd call them growing pains.
Well, and Andy, hang on for a second, because we've got to do some news, and we don't want you to get cut off. So we're going to continue this and get you to weigh in on that aspect of the business when we come back. We're talking with Andy Worth and Bodie Miller, as we said, of the Peak Ski Company, co-founders. Andy also CEO, Bodie also Chief Innovation Officer. And there was a great story that was written by Bloomberg Businessweek that really gives you details about what they set out to do, what Bodie set out to do. And it is interesting. I love when, he obviously has learned a lot about the business and how they were doing it. And just this idea of being able to manufacture much more quickly changes the mathematical business.
And also what skis worked for him when he was young, when he was racing. So we'll get into all of that.
Let's get right back to Andy Worth, CEO and president of Peak Ski Company, and Bodie Miller, Olympic and World Championship gold medalist and the chief innovation officer at Peak Ski Company. They join us on Zoom from Montana. Bodie, I want to go back to you because I was struck when you said after the first year you were frustrated about not being profitable. But I mean, it's really tough for a startup, and I think the expectation to actually be profitable after 1 year. I mean, look at Amazon, for example. It took like more than a decade to regularly become profitable quarter after quarter. Why were you expecting to be profitable after the first year?
I sort of touched on it, the margins. The margins, if we, that we did model out quite a bit. Andy's a bit of a quant, and, I always like to sort of use all of our experience and knowledge. I didn't feel like either of us were very naive coming into this. But the margins on our product are good, and we're selling right in kind of the sweet spot of where they typically net out for a high quality small handmade ski company. But the challenge was quality control. It's a byproduct of the manufacturing process itself. It's just very inexact. You're using materials that have variances to them, and the assembly process is pretty as I said, it's analog. And so there's us being direct consumer, we didn't feel like we had the latitude to give anything but perfect skis to people. So we ended up with a lot. I think it was close to 30% of our inventory didn't pass the QC inspection of the manufacturer. So wow. It wasn't us nitpicking. It was just the reality, and that was way outside of our modeling, and that was tough. But the great news is we sold through mid 90% of the inventory we had, which was basically above or right near where we projected. So all of our projections that we could control were good, and that would have led to profitability. The part that was the problem was we didn't have the inventory to sell to get our numbers. But again, that's part of the inspiration or the drive to re-engineer the manufacturing process, because everybody wants better stuff, quicker, cheaper, and more precise. Right. And that's what we're sort of delivering.
Hey, Andy, come on back in here, because you're building this business with Bodie. I'm wondering where else you can go here, because I know you guys were talking about doing a Bodie Miller Ski Academy. You ended up pulling the plug on the Granby Ranch location in Colorado back in 2022. Where else can you guys go as a partnership?
Well, kind of the sky's the limit, as they say. Neither of us feel like retired guys nowadays. I can tell you that for darn sure. We come at this business and this effort with a great deal of passion for the outdoors, the mountains, certainly from the ski industry, different angles of attack, but similar ethos and way of approaching things. There's a couple of different ventures that we have that we're taking on and considering right now. All of our emphasis and focus is on Peak. And the primary reason being is coming back to this reengineering of the entire process by which skis are made. That puts us in a position to be 3-4 years down the road having our machinery process that we, with a smile on our face, we call a treadstone, because it is fairly confidential information that we're working with this group in Germany. But nonetheless, it's something that we anticipate being a place where we can have 30, 35, 40% of the world's market share made on our machines and our process. And that is where, when I mentioned value creation, that's where it comes into play.
So does that mean, Andy, you guys will be making skis for other companies, other brands?
Yes, ma'am. In fact, might be interested to know my best effort at a Yogi Berra-ism is the least important thing about our company are the skis, but they're critical. And the reason being, the skis are critical, but at the same time, we're in this to innovate for the innovation on so many different fronts, including the process.
Right. So Bodie, it's like becoming the Luxottica of skiing, right? Like you don't care what the brand is, but if you can improve the process, that's okay. Or being like a foundry.
You're talking about really established companies, but the irony is, besides attaching and incredible people, Andy and I are big fans of many of the companies that we're competing against. And in this way, we're not looking to steal market share from them, because at a certain point it becomes annoying to manage logistics. In this case, our goal is to have 10 purchase orders and be delivering 2 million pairs of skis. And the advantage that I don't see it stopping there, because we can deliver them for $20 or $30 or $40 less than they make them for themselves now. Plus, they can divest of all their other sort of liabilities, even though a lot of their equipment's amortized. Right. They understand that there's a lot of fluff there. There's a lot of loss, and we can we can clean that up, as well as there's things like gray market skis that, there's a little bit of the inventory is out of control. So I don't see it stopping. I can't see a company saying, hey, build us these 500,000 pairs and we're going to build the other 500,000 for $40 more and deal with 15% waste.
Yeah. Their accountants or their whole financial team might say, wait a minute, let's talk about that. Guys, the impact of climate change, Bodhi, and the lack of snow, how are you incorporating that risk and reality into your business? I mean, we've finally seen some snow here in New York City, but it's barely a sprinkling here. But innovating with the idea that more and more skiers may be skiing on man-made snow, how does that come into it? And Bodhi, we've got about 30, 40 seconds here.
Yeah, it's just the reality that we're facing. I think the ski industry is remarkably healthy. I don't think it's an immediate thing for the ski industry. I think it's certainly important that we be dealing with it and addressing it. And in our company, recyclability of the skis is a huge part of the technology we're working with as well. So, I don't see it being a massive problem, but you are going to have years like this year where it's been really tough. The beginning of the season's been tough.
But do you innovate differently? Bodhi, do you make different types of skis because of maybe more man-made snow?
No, not really. I mean, you think of man-made snow as on-piste, and then there's off-piste skis. And yes, the trend has been going much wider. So we certainly address that end of the market where it's on-groomers, on-piste skis. But the reality is there's a huge demand across the board.
Right.
Hey, Andy, we got about 30 seconds left. I want to give you the last word here and just ask you what's top of mind as we begin the year here and you guys are trying to build this company.
I appreciate that, Tim. And I got to augment one point here is that the climate change matter is something that's an exigent threat for us overall. And what we do is, number one, we reduce our footprint. Number two, we're doing everything we can with this process to actually localize where skis are made. And so that's a pretty substantial contribution in favor of that. But relative to Peak and what we're doing, I'd emphasize the fact that we have Bodhi, and he's got this brilliant Mensa level creative mind that is unique. It's almost like Chuck Yeager working with Lockheed Martin on the Mach capable airplane back in the 40s. He's got this unique ability to be an engineer, but at the same time put those skis on snow. And that's what enables us to take this all on.
It's a nice compliment.
Very cool. Thank you guys for joining us. Andy Wirth, CEO and president of Peak Ski Company, and Bodhi Miller, Olympic and World Championship gold medalist and chief innovation officer at Peak Ski.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business App. Or watch us live on YouTube.
Hey, Carol, you remember Y2K, right?
Really, really well.
You were actually working here at Bloomberg.
Yeah, I think I just started. And one of the things that we were thinking about big time was what happens when we go from 1999 to 2000. And apparently that can be somewhat difficult, sophisticated, complicated when it comes to technology and computing devices. Like, what does that mean, right? You go from a year that you specified, right, with 2 digits to all of a sudden you really needed all 4.
Yeah, so
can I just tell you that we were, all of us in the news team, we went home, we were given walkie-talkies and everything because we thought in case the phones don't work, and we had to be ready for when in, I guess, Asia or whenever it struck 2000 around the globe first for like the world to come undone. And I got to say, I remember, like we're waiting, nothing happened.
Nothing happened. Well, a new HBO documentary takes us back to that time. It's called Time Bomb Y2K.
Y2K. What does it mean? Using 2 digits rather than 4 made good economic sense.
But when workers advanced clocks to the year 2000,
the world could melt down. Our systems are broken.
We've got a problem with a couple of digits.
This has to be solved.
All right, that was a clip just from Time Bomb Y2K, new documentary on HBO taking us back to the years ahead of Y2K and all the chaos and prepping and fears about power grids failing, nuclear arsenals being at risk, planes falling out of the sky. People were very worried, Carol. Well, Brian Becker and Marley McDonald are the documentary filmmakers and producers behind Time Bomb Y2K. They join us on Zoom from New York. Good to have you both with us this afternoon. Brian, I want to start with you. Why make a documentary about Y2K 24 years later?
So when Marley and I first thought of this idea and started looking into it, it was the summer of 2020. And the first images you see when you Google back Y2K are shots of empty grocery store shelves and people checking out pallets of water and toilet paper at the supermarket and people in line at the gun store. And those images felt awfully familiar to us, as given the reality we were living through in the depths of the pandemic. We knew there was a countdown. We knew from our research that there was extensive footage and media coverage of the event. And kind of living in that moment of the pandemic made us realize that it wasn't just a countdown. It wasn't just something that we lived through and then had mostly forgotten about. It also had, we thought, lessons for our present moment.
Well, I got to say, Marley, I just remember doing interviews, leading up to it, and every conversation, certainly if it was even just a general market interview, it was like, okay, so how are you guys planning for Y2K and concerns that, things come undone and, we can't track investments or markets don't, work properly. Having said that, when you and Brian went to pitch this, were people like, wait, what was Y2K? Because it's a long time ago.
Definitely. Well, everyone who lived through it remembers it, which definitely worked in our favor when pitching this around and was a really special part of making this project. When you tell someone you're working on a movie about Y2K, everyone has to tell you what they were doing New Year's Eve, 1999.
Well,
so
can I just tell you, one of my producers, I think, was in kindergarten. So that kind of like hit home. Anyway, continue, please.
Yeah, Brian and I became historians of what everyone was doing on New Year's Eve, 1999. But when we first started looking into the project, the first question that comes up is, was this a joke or was this real? And, a lot of people remember Y2K as a hoax. And it took us months of research to come to the conclusion that it was a very real problem that was solved. And we did that by talking to a lot of computer programmers and talking to a lot of people who actually worked on the issue. And so we knew we could kind of reclaim this narrative in this movie and shine a light on all the work and labor that went into actually fixing this very real problem.
Marley, can you talk about the style here? I enjoyed the film, but I was surprised to see the way that the documentary was structured, in the sense that there's no narrator and it's nobody looking back or remembering or there are no recollections. It's purely based on archival footage, on videos that were sold at the time, news reports, home videos. Talk a little bit about building it in that sense.
Yeah, so we knew we wanted to do it all archival from the jump because, one, there was just enough footage. There was a lot of footage. And when we first started working with the material, we realized that, everything was sort of there, and that if we kept it in the world of all archival, we could really kind of make this countdown feel more present tense, feel like a time capsule of that actual moment. And Brian is an archival producer and found, along with our team, all of that footage. We ended up with over 700 hours of footage. And as far as the structure of the film goes, we knew that we wanted to sort of replicate the way that Y2K worked in the world. So starting with the technical problem, watching it sort of radiate out of cubicles and into the social consciousness, and then follow that to sort of the fringes of America. And we knew we had to get to midnight at some point.
As you went through the footage and you guys were gathering it, Brian, what was it that kind of jumped out? Was there certain things that were like, oh my God, like it was just kind of interesting? Because there was real nervousness about how this might play out.
Yeah, there's a certain attraction always to footage that is kind of unbelievable to watch in the present, whether it be, a tape made by a militia titled Y2K, why should I care? I don't even own a computer. But I think what we really started looking for, most specifically in the footage, were moments that could clearly tether us from present to past. Because we didn't include interviews with individuals in the present day, we were looking for kind of moments of emotion or introspection or relevance between then and now. But of course, when Matt Damon is recorded speaking about the nuclear arsenal and his fear of the nuclear arsenal potentially shutting down, you kind of have to also include things like that in your movie.
A very young Matt Damon promoting at the time the talented Mr. Ripley, I should note. Hey, Brian, have you heard from any of these folks who were featured in this?
Yes, thanks for asking that. we actually have relationships with all of the individuals who we built scenes around in this film. It didn't feel fair for us to include their historic likenesses in our feature without talking to them first to gauge what Y2K meant to them. So, for example, Peter de Jager, who is one of the first individuals who kind of brought Y2K to the public's attention, I spent 2 days in his basement with him outside of Toronto. He just published a new book focused on computer management, and we just appeared on Peter's podcast about Y2K, which I can plug here. Candace Turner, who in the film calls herself Farmer Jane, I emailed with Candace this morning, and I went to her farm in Sarcoxie, Missouri. She moved there, she lived there in advance in the lead up to Y2K, and she still lives on that very same farm. I went to her mudroom and came back to New York with some VHS tapes of hers.
Yeah.
Toscanins in D.C. So we do have relationships with these people.
You know, it's interesting, Brian and Marley, that it's been a week where Tim and I have been talking a lot about the risks in 2024. We certainly did at the end of last year and into the new year, but this week, you know, some of the concerns were big time the November elections and basically the U.S. against itself. Geopolitics certainly came up, and it made Tim and I think about how your documentary kind of ends up. We're essentially just before midnight in the U.S., December 31st, 1999. You have Boris Yeltsin, right, conceding power to Vladimir Putin, who would take over to lead what was then, the Soviet Union, right?
No, the Soviet Union had broken up. It was just Russia.
Yeah,
and there's this ominous sort of moment from the newscaster that says, you know, Putin wants this to be a strong Russia, but has no ambitions beyond, like for expansion and to get bigger.
Here we are 24 years later, and we know that that's very different. But I do wonder how you guys are thinking about, having gone through this process, about some of the risks and the concerns that are out there today. And coming off a global pandemic that really made us all realize, whoa, our life can change dramatically and our lives are at risk.
Yeah, you know, it's an interesting thing. So our movie actually premiered at a festival last March, and during the Q&As at that time, a lot of the questions were relating our film to COVID. Then sometime over the summer, the questions started to become about the threat of AI. And so it's interesting to kind of see how this movie moves through the world as it continues, you know, going through different existential threats. And that's, I think, what we wanted to do with this film, is really examine the ways in which America faces existential threats and kind of the focus on how interconnected and dependent we are on each other, and really highlighting that aspect of getting through things like Y2K or COVID.
Every time I think that we collectively go through an experience that will somehow bring us closer together as citizens, I turn out to be wrong. I felt this way during COVID, that sort of like everybody was in this together and it would be this uniting force. And I look at the landscape right now, Brian, and I think that we've never been more divided ever than we have been right now.
I feel the same too, Tim. Y2K almost feels like this dry run in which we actually did succeed in solving a problem, and then, of course, in very American fashion, quickly dismissed it as a joke or as a hoax after we went through it. It almost feels as if we worked on it so well and solved it to an extent that we would have learned more if more things went wrong after the clock struck midnight on New Year's Eve 1999. Instead, we kind of missed this opportunity to think so much about how our lives had come to depend upon technology and also on each other to an extent.
You know, it's kind of interesting on a day where, safe to say, we all got fooled about the approval by the SEC of a spot Bitcoin ETF, where a headline crossed on Twitter from the official SEC account. And then 10 minutes later, the chair of the SEC comes out and said, no, that's not correct. They have not received approval, and that the SEC Twitter account was compromised. You just realize how quickly and how vulnerable we are and reliant on technology, and how things can be misconstrued, got wrong. And you just, I don't know, when you start to extrapolate that, you just wonder kind of, Tim, where we could go with this.
Yeah, it also, you know, it was so interesting to see that the way technology has shifted. And, you know, it's been a quarter century roughly since this time period, but the technology shifts that we've seen have been absolutely massive.
Yeah.
Marley, it
and
also
our reliance. I feel like,
reliance
on technology.
There's this picture. There's a picture painted, Marley, in the 1990s about the optimism about technology, and I'm wondering if you think that the optimism that these folks in the 90s talked about and alluded to about school children being able to access information at any time has actually manifested in something that looks optimistic or looks, you know, scary. I mean, there's talk about parents being concerned about TikTok, mental health and social media, government control of this stuff. I mean, what are your thoughts there?
Certainly, I'm very concerned with the state of our relationship to technology. And I think that was something that we really wanted to sort of capture, that techno optimism of the 90s in our film. You know, this was the first time that people were really welcoming computers into their lives. You know, it was at their office or in their home for the first time. But I think what Y2K revealed is just how dependent we actually already were on computer systems that we weren't seeing, you know, to get on the train or how we get the news in the morning. Like everything had already been kind of operated by these giant systems, but we hadn't come face to face with that. So I think Y2K was an interesting moment for kind of deconstructing our reliance on technology. But yeah, as far as where we've come today, you know, we've only gone deeper in that hole. And like Brian says, it could have been a moment where we had pivoted and maybe taken a different route. But because we did get in front of the problem and solve it, we've just gone further and further down this road. And if something like this were to happen today, you know, the same questions would arise.
Hey, we only have about 30 seconds left, Brian, but I want to give you the last word. What's the next thing you guys are working on?
I'm working on a film about the rise and fall of the American enclosed shopping mall. And Marley, I'll pass it to you to describe what you're working on.
I'm developing a film based on the archives at the Museum of Natural History and the origins of natural history museums.
All right,
Very cool. Big thank you to both of you for joining us. Everybody check out the new film. It's on HBO. It is all about Y2K. It's called Time Bomb Y2K. A big thank you to our guests, Brian Becker and Marley McDonald, the documentary filmmakers and producers behind Time Bomb.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.